Today's episode of Hidden Forces is made possible by listeners like you. For more information about this week's episode or for easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to overtime segments, episode transcripts, and show rundowns full of links and detailed information related to each and every episode, check out our premium subscription available through the Hidden Forces website or through our Patreon page. And remember, if you listen to the show on your Apple Podcast app, you can give us a review. Each review helps more people find the show and join our amazing community. And with that, please enjoy this week's episode. What's up, everybody? I'm Dimitri Kofinas, and you're listening to Hidden Forces, where each week I speak with experts in the fields of technology, science, finance, and culture to help you gain the tools to better navigate an increasingly complex world so that you're less surprised by tomorrow and better able to predict what happens next. My guest this week is Daniel Paris, a senior portfolio manager at Federated Investors in Pittsburgh, where he oversees the firm's dividend-focused products. He is the author of 3 books on investing, most recently, Getting Back to Business, Why Modern Portfolio Theory Fails Investors, and How You Can Bring Common Sense to Your Portfolio. Before transitioning into asset management, Paris was a historian focused on modern Russian history. He is the author of a book and several articles on the Soviet Union in the 1920s and 1930s. Today's conversation hits on 2 of my favorite topics: financial theory and financial history. In fact, the conversation is about the evolution of financial theory, beginning with the rough and tumble world of the 19th century with its stock syndicates, market corners, and curb exchanges, where big personalities like Daniel Drew, James Fisk, and Jay Gould conspired and fought to take from Joe Public and from each other the riches afforded by laissez-faire capitalism and the Industrial Revolution. The conversation is broken into 2 parts: the world as it was before 1929 with its unregulated, unstructured, and highly inefficient markets, and after, where a confluence of forces, economic, demographic, institutional, and intellectual, supported the procurement and distribution of a new set of financial theories that promise to explain away uncertainty and guide the allocation of risk in the pursuit of profits. How these theories came together to form the dominant ideological template of risk-adjusted return measured against exposure to the broader market is the essence of today's conversation, and its significance can be found in the implications of equating diversification with correlation, trading idiosyncratic risk for systemic risk, and what happens when everyone is doing it. And with that, let's get right into this week's episode. Daniel Paris, welcome to Hidden Forces.
Thank you, Dimitri. Happy to be here.
It's great having you on the program. I wasn't going to ask you about this, but I think we're going to have a good amount of time to go through this episode, which I'm extremely excited about. For those who can guess it from the title, this is going to be an exploration of financial theory, beginning with the qualitative universe that existed before the crash of 1929 and the interwar period, and then the quantification of that happened afterwards with MPT and a lot of these other theories that became adopted and integrated into financial frameworks. But why don't we start with your background? First of all, what do you do now? Just give us a general sense of what you do now and your academic background and how those things all work.
Thank you, Dimitri. It's sort of an odd history, and I can't imagine or say that it was forecast to work out this way. But I started out as a historian of the Soviet Union. I was trained in the late Reagan Cold War era, the 1980s, fully expecting perhaps to become a diplomat or an academic, and got a PhD in Russian history, early Soviet history. And then Russia collapsed, the Cold War collapsed, funding collapsed, enrollments collapsed, the world moved on to other areas. And I made a decision to leave academia and go into business. And I brought with me some competency in writing and research, and through a series of jobs and unforeseen developments, I ended up doing financial research. One thing led to another, and after a few years, I had a second career and have been at Federated Investors in Pittsburgh for the last 16 years, and I oversee the Dividend complex of equity funds and portfolios, institutional accounts there.
So your background in Russian history, did you have just always a general interest in history?
Yeah, I still really primarily identify as a historian who happens to work in the capital markets by day. And in the strategy that we employ in the products that I oversee, it's fairly historically rich and historically argued in this book and two prior ones that, hey, this methodology makes a great deal of sense. And it's interesting because I work in a field, finance and investments, which I would argue has almost no historical sensibility. Very few people know where the rules came from. That's why I wrote the most recent book. And whether that the context or the history of those rules matters now, I argue that they do. And I'd like to think that being a historian, ironically, brings some sort of competitive advantage to being a business owner through the stock market.
That's an interesting point, where the rules came from. I am also fascinated in this story of origins. I remember when I was a kid, I would look at door frames and say, well, where did those dimensions come from? When I started looking into things, I realized that there was often a very good reason for why something existed, but that it was no longer relevant. And I think that this holds true in spades for economic theory and financial theory.
I couldn't agree with you more. That is, we are operating with some financial theories that are now 50, 60, 70 years old, were very clever at the time that they were created, met a pressing need at the time that they were created, which we'll get to. But they're not everlasting, forever, perfect, immutable. And I think investors too often just quickly memorize the rules and assume someone else has checked them out and that they're good to go. It's not the case. The rules do change over time, and they need to be looked at.
Immutable. There is this sense, particularly with economic theories, I don't know if it holds. The financial community innovates, I think, much better than academia and government. But there is certainly in the economic field this sense that the rules are immutable, and that, as I said to you before we started this interview, most people think of economies as phenomena that are independent of the political system within which they operate, which is completely not true. But let's go back to kind of the world before the crash of 1929. This universe that I described as qualitative, because you do a great job in your book. You are a great historian, and I love financial history. So actually, I want to ask you before we even start, what draws you in particular? Because financial history is such a unique type of history. I'd love for you to tell me what you love about it and how it separates from other types of histories that you study.
Well, in many ways, almost all forms of history are about human behavior. And you can see collective human behavior, you can see individual human behavior, but the great variety of human behavior, emotion, rationality and irrationality. Behavioral finance talks about too much maybe about irrationality, and modern finance talks too much about rational behavior. But the fact is it's somewhere in between. And the history of the markets is just so colorful, from Dutch tulips to the English and exploration to Louis Bachelier figuring out the French bourse in the 1890s. They're just tremendous human stories. And as a historian, that appeals to me. And then I go to my day job and I look, and there's been a tremendous effort the last 3, 4, 5 decades to completely eradicate the human element to investing, even though these are people's hard-earned retirement assets, a lifetime spent, and it's just swallowed up in some sort of algorithm. And that's really what I'm pushing back against, that the history of finance is intrinsically interesting, and I think it's relevant when kind of pushed up against these models and formulas that are supposed to take the human element out of our lives. I mean, we are not all Dr. Spocks, Mr. Spocks, or Lieutenant Datas, and I don't know that I would want to be in a world in which we all were.
It's funny that Spock didn't have a PhD. It was actually Mr. Spock. So, of all people, you'd imagine that he would have a PhD. He'd have multiple PhDs. You made some great points, one of which is that the history of financial markets is the history of individuals. That was true. I don't know how true it is today. It was true on an epic scale.
Indeed.
In that period. Some of the most amazing personalities, Gould, Fisk, Vanderbilt in the early days. Livermore, all sorts of fantastic individuals. And
Groucho Marx. Don't forget Groucho Marx. The book opens with a Groucho Marx anecdote. How bad can a book be if that opens with a Groucho Marx anecdote? He was very interested in the markets. David Sarnoff, the
RCA CEO.
All sorts of very interesting characters. And, they are the Jeff Bezoses of the day, and to some extent also the Bernie Madoffs, I have to say. And you are correct that the theories, the mechanistic and non-individual theories have taken over the last 30, 40 years, but there's still room for personalities, I argue, and human behavior in current investing, and it just comes out in that historical investing. But the point is, what was that period like? It was dominated by personalities and individuals. What was characteristic, I think, and important from our perspective is that it was largely a rule-less period. It was chaotic. It was whatever goes.
There were actually fist fights between people.
There were multiple markets on street corners. Everything was very personal.
Exchanges.
The curb exchanges, the exchanges in each city. And it was a, subjective characteristic of the markets as opposed to the black boxes in the machines, which we now take for the functioning of the markets. And again, there's nothing wrong with the black boxes in the machines, but I'm just pointing out that's not always been that way. And there is a price to be paid in removing the human element from investing and the getting back to business element of individual judgment. Listen, the challenge of life for all of us is decision-making under conditions of uncertainty. What do we do? Where do we go to school? What job do we take? Whom do we live with? What choices do we make? And that's the nature of life. And the successes and failures of making decision-making is what characterizes us as human beings. We don't usually get everything right. If you get 51% right, you've probably had a good life. The modern environment has removed a lot of that in favor of algorithms. We'll see how well that works out.
Mm-hmm. The black box, yeah. You mentioned the curb exchanges and the way that things were done. There's this great book that was published in 1992 called Land of Desire by William Leach. I've mentioned it before, and it's a history of consumer capitalism. And one of the things it discusses is the growth, the birth, and the proliferation of the department stores. And to remember that before the department stores, before the plate glass windows and the sets, people would go to open-air markets and go through hangars of clothing. But you mentioned Groucho Marx, another great historical anecdote, because it touches on the brokerages, the way the brokerage used to be, right? Today, people don't even have it. It's like Charles Schwab. It's like your brokerage account is, a piece of software. Mm-hmm. But then they were very different. What was it like? First of all, how did someone, let's say I lived in Oyster Bay, or I lived in Great Neck or somewhere, and I had the money to invest, and it was the 1920s, my neighbor was making some money, and I'd said, you know what, honey, I think I'm a smart guy. I think I can make some money. How did I go from the desire to invest in the stock market to being invested?
Yeah, so entirely different landscape than today. And there may be some analog. Maybe it's the coffee shop, or you and I, Dimitri, were talking before this taping, but there were 10,000 different brokerages, 10,000 different ticker tape machines, and thousands of different brokerage offices around the country in the 1920s. And they were social places. They had the plush leather couches. They had the teenagers writing the share prices in chalk on the board. They had everyone sitting around and kibitzing and talking about what's going to go up and what's not going to go up, and what the government policy will be, and the gold this and the gold that, and foreign relations and trade. And it was a social place to be. It certainly wasn't a kind of an academic environment of a rules-based system. It was, again, interwoven into the culture of the time.
It's a clubhouse with a ticker, though. You said the ticker tape.
With a ticker tape
That's
machine.
How people were able to figure out what the price of the market was. They actually, only way they could do it was to go to their broker and look at the ticker.
Unless they wanted to wait until the next morning when it was printed in the newspaper. Many of older listeners will remember when newspapers published share prices. It wasn't that long ago. It's only a few decades ago. But certainly when I was growing up, that's how you learned about the share price, was by looking in the newspaper. But if you wanted to learn the share price before the newspaper came out, either the evening edition, again, newspapers had evening editions, or the next morning, you would have to get near a ticker tape machine.
I remember Livermore talking about how he was extremely wealthy at his peak before he finally lost it all for the final time. But he had a boat. I don't remember what the name of his yacht.
Yeah, I don't recall. It's in the book, in the famous account of him.
Yeah, in the Reminiscences of a Stock Operator. Yep. Didn't he have some access to telegraph machines on or near the boat? I don't know how he would have it on the boat.
Cruise ships. The way to get across to Europe was on a cruise, or not a cruise ship, but just a steamship. And they had, through telegram systems, they also had ticker tape machines on the boats, and some of them. And you could.
But how did they access the cable?
Yeah, I don't know. It must have been early wireless somehow. I don't know exactly.
Anyway, somehow I remember that Livermore had that, I don't remember how it worked exactly, but he was as connected to the markets as anyone could be. A great book, obviously. Before we continue and leave this period, I am curious if you have any particular favorite stories. I think my favorite of all is when James Fisk and Daniel Drew and Jay Gould tried to corner the Erie and screw Vanderbilt out of the Scarlet Lady.
Yeah.
And, of course, the gold ring with Ulysses S. Grant's a great one because that was just the fact that a president was involved in this process of speculators trying to corner the gold market and screw the government. Do you have any favorite stories
the
from
RCA
the time?
story, which is described in my account, is a good example of the environment, which is where a bunch of well-placed investors and market makers could manipulate the share price for their own benefit. It wasn't illegal, and it wasn't that hard to do. And there are many other stories in the lesser literature of the day that don't involve the Fisks and the Goulds, that are more anecdotal about, particularly involving mining items, mining propositions, mining shares. And if you read the literature of the time, there are lots of advertisements for, hey, if you buy these shares of this mine, everything's going to work out just fine. Again, the economy was more oriented towards extractive industries, and there was much greater risk associated with those ventures. And again, everything was not listed. There was no reporting. There was no regulation. Most companies did not make quarterly reports. Few made annual reports. You really had to take it on kind of trust that what you were purchasing made sense. There was little to any visibility into corporate governance and to corporate activities. And again, you were lucky to get an income statement or a balance sheet once a year. So it was a real ruleless period. Nevertheless, I think it's important to point out, capital was raised. Railroads were built. Factories were built. Utilities raised funds. The infrastructure of an industrial society advanced. It was helter-skelter, but it advanced. It's easy to just look back and say this period was without rules and full of scoundrels.
It was a romantic time.
But still, a lot of things got done. And so it worked after a fashion, but it was truly ruleless. To the extent there were rules, as I make it a point in the early chapters, they tended to be on the equity side around the health of a company's dividend. But, that was one way to test the health of a company because you had very little additional information to work with.
You mentioned RCA, you just mentioned a dividend. They didn't issue a dividend, right?
Yeah.
They were one of the early stocks that actually didn't.
Well, it was a tech stock.
Right.
And so, as Groucho Marx said, shouldn't it pay a dividend if it's having a lot of success? You could make ask the same question of a number of currently very successful businesses. And, if they're that successful, why wouldn't they pay a dividend? Now, they have an answer for that. And that answer is sufficiently compelling to most investors in the 1990s and aughts in the current decade that they don't actually need to pay a dividend. But Groucho's question was, I think, simple in its premise. If it's a successful business, why wouldn't it have a cash distribution?
They should call that the Groucho's paradox.
Yes,
should coin
indeed.
that. That's the dividend irrelevance theory, right?
Well, the dividend irrelevance theory, so Groucho's or RCA's approach and Groucho's questioning it becomes then indirectly, of course. Miller and Modigliani, academics in the 1960s, weren't engaging in debates with Groucho Marx, but we'll get to that in a moment.
We'll get to that. Before we get to that, I want to close off one more thing when we're in this past period, because you mentioned on it, you touched it about the information at this time. First of all, today, if you go onto Times Square and you ask any random person in the street, how's the market doing? Even if they don't know how the market is doing, they're not troubled by the question. Right? They have some sense of it. They can say, well, let me just check. Mm-hmm. I'll check the Dow. I'll check the S&P 500. In this period that we're describing, there was no objective measure of market health. The people that could tell you how well the market was doing were people that were actively trading it, people that were involved. But this was a qualitative period. It was not a period yet where people had brought order to the chaos of the market. Can you give us sort of the origin of the indices, of quantification of the newsletter industry? How is this coming together, the informational side of this business, coming together before the crash?
Yeah, so there was no way to keep score. And that really became an issue as the stock market became more popular in the late 19th century. People wanted a way of keeping score. Interestingly, it doesn't come to individual accounts for a while, but there were homegrown small measures of market performance from the newsletter and from the journalists in the late 19th century, 1890s, and then continuing into the 20th century. That's where the Dow Jones Industrial Average comes from, the transports, the utilities. S&P didn't exist at the time, of course, but that which became S&P gets into the act in 1922, 1923, and 1926 with various measures, and you begin to be able to keep score on a daily or weekly basis as to how the market's doing. Prior to that, It is a subjective measure. The market's performance back to 1870 was subsequently figured out by guys at the University of Chicago, but at the time, nobody knew. And again, the newsletter writers, they would keep simple story. They'd take 10 typical railroads and come up with a simple arithmetic average that didn't include the dividend payments, and they would track things that way. It was a very primitive way of doing that.
What was it? I mean, the early indices just had what, industrials and railroads? What were the early stocks?
Yeah, railroads and everything else.
Railroads were the tech stocks at the time.
Railroads dominated, so it was railroads and everything else. Financial institutions were on the curb at that time. They were not inside.
Literally on the curb.
Yeah,
they were outside.
It was called the Curb Exchange, then the American Stock Exchange, and then it came inside. So it was mostly railroads and a smattering of everything else, including industrials and utilities, but it was a period dominated by railroad stocks. So this is all pre-1929. No rules, not no rules, but very few rules. The rules were limited to the agreement that a company might have had with an exchange, a listing exchange. Very few ways of keeping score, some ways, but very few. And no overall theory of investing, and certainly no portfolio theory.
And certainly no efficient markets. They were very inefficient.
Markets were very inefficient, and there were no academics screaming and saying, don't do this, do this. So it was fascinating. It was very human. And again, a lot of railroads and factories got built, but from an investment perspective, it was catch as catch can and individual tales of success and failure.
A great time for active managers. So I'm going to pull a quote from John Moody, and it refers to Carnegie's famous quote, put all your eggs in one basket and watch that basket.
Correct.
Right? The philosophy of investing at the time, I think, was encapsulated in that quote of Carnegie, which is that the best way to invest is to know what you're invested in and to watch it very carefully, right?
Indeed.
So here's a quote from Moody. John Moody, this is the founder of Moody's, the derivative of the current
bond rating
agency. The average investor simply cannot watch the basket in the way implied by Mr. Carnegie, and therefore it is a safe principle for him under all ordinary circumstances to limit his chances of loss to the greatest possible extent through a wide and judicious distribution of his capital. I pulled that quote from your book because I was trying to think about where and when these early notions of diversity and diversification came into the public mind, because, of course, this is a fundamental staple of modern portfolio theory, and I just wanted to put that out there. So we're going to get into that in this next phase. So the crash of 1929 happens. We don't need to go into all of that. We could be stuck there forever. But out of the crash of 1929, I think, similarly to 2008, which has spurred the interest in theories of behavioral economics and alternative models for understanding complex systems analysis, nonlinear dynamic systems, as opposed to equilibrium, which is what we've lived through for most of the post-war period. How did the crash of 1929 lead to the development of some of these models like MPT, Markowitz's MPT, and the efficient market hypothesis and things like this? How did that whole thing happen?
Yeah, so it's a great question, and there's a lot there. Again, just on the diversification issue, which we can kind of follow as a thread, as an example of how a ruleless period becomes a rule-filled period. And that is, again, Carnegie's suggesting owning 1, 2, 3, 4 stocks. As a matter of fact, that was considered kind of standard at that time. You would invest in a very concentrated manner. So let's just remember that when Moody and the others, and there are other examples of what I would call common sense, non-academic diversification, maybe not even using that term, that are evidence prior to the post-war period when the academics come out in favor of this. But they are responding to a period in which the alternative was a handful of securities. The issue that current investors need to keep in mind is that the argument of diversification was never about owning 1,500 securities in your portfolio. It was a response to Gerald Loeb and Andrew Carnegie about owning 5 securities in your portfolio. Harry Markowitz and the others, and Moody, even before, are making an argument not about index funds and just owning the entire market, but pointing out the kind of common sense, intuitive risk management that comes from not owning 3 or 4 securities a la Carnegie. So how did this come about? What led to the shift from kind of common sense rules of behavior for or guidelines for investing to this very rigid structure that we currently have today, which is still built around modern portfolio theory, a phenomenon of the 50s and 60s? And the answer is that, the crash really mattered, and it affected politics, it affected economics, it affected investing, and it affected academics. In the 1930s, a number of high-profile business people and academics said, boy, that was a mess. Ben Graham is one of them. John Burr Williams is another. John Maynard Keynes, who's known for many things, is involved as well in trying to figure out the stock market. Why? Because the Western world was in crisis. You had endemic levels of unemployment. There were competitive systems from the Soviet Union and Nazi Germany. And what went wrong, and what can we do to come up with a better system? That leads to, John Burr Williams, Maynard Keynes, and Benjamin Graham come up with their, I won't call them theories, but their observations in the 1930s. And I write a lot about the contributions that they made because they were what I refer to as the founding fathers. And then the war happens and all this gets set aside. And the academics in the 1950s returned to these issues raised by Keynes, raised by John Burr Williams, raised by Benjamin Graham to say, okay, let's go back to this. These guys did good work, but it's incomplete. And what they're bringing to the table, and this is some of the things that I think you wanted to touch upon, is they bring in the post-war period where there's prosperity, there's a lot of time for academic thought, they're bringing kind of systems theories, equilibrium theories, though they wouldn't have called them at that time. They're bringing macroeconomic top-down theories of human behavior based largely on what we now call rational actor theory, but again, they wouldn't have used that term at that time, to explain the markets and to try to come up with a system that would, if not prevent, then at least explain and largely allow people to sidestep the ups and downs of the market. There are a lot of examples in the book. 1950s and 60s was filled with social science. It's filled with the moonshots. It's filled with televisions and the technology that televisions represent. I have a little anecdote about, George Jetson flying around on your Magnavox television in your room. It was a period in which social science, instead of history and politics, you now had social science, meaning that human behavior could become rules-based. And that period of the 1950s and 60s, it began to be applied, not surprisingly, to not only economics, but also finance and stock market behavior. And so you get to, we'll describe it in a moment, but you get to MPT and eventually the efficient market hypothesis and capital asset pricing model as these simple, formulaic explanations of human behavior based on rational expectations theory that would explain how markets work and finally provide an answer after roughly 30 years to what happened in the crash. Even though, again, Harry Markowitz, one of our characters, and Bill Sharp, one of our characters, they wouldn't say, and both of them are still alive. You can ask them.
Are they? I didn't know that.
Yes.
How old are they?
Harry Markowitz is in his early 90s, and Bill Sharp is not in his early 90s. He
was a student of Markowitz, wasn't he?
Yes.
He was a graduate student of Markowitz.
So they're both, and hopefully they'll continue to live long and prosperous lives. We
wish them well.
We wish them well.
We don't wish them any ill.
And with the passage of time, I have to say, they both appear wiser and wiser. It was what was done in their name that I have an objection to. But in any case, they would never say that they were explicitly dealing with solutions to the 1929 crash. But if you follow the intellectual history of what they're coming up with, it is a response to what seemed like utter craziness in the 1920s.
I want to get into that. You mentioned Graham and Keynes and
John
Burr Williams. Benjamin Graham and David Dodd published Security Analysis in 1934. Keynes published The General Theory
1936.
In 1936. And then 2 years later, 1938, Williams published Theory of Investment Value.
Correct.
For example, I know one of the things you mentioned in the book is that if you compare Williams and Graham to Markowitz, their objective was expected return. Correct. Versus what would become Markowitz's focus, which was mean variance. What were the important ideas or frameworks or theories that came out of those early works in the 30s of the authors I just described? And then how were they put to work in MPT by Markowitz and later by
Great question. So Ben Graham simply creates a framework for understanding companies that had not existed before, a long diligent process of sharpening pencils and doing all the work to understand companies. And amazingly, that level of diligence for investing and for company knowledge passes for the term value investing. But what really his contribution was, take the time to study what you're doing and make the effort. And if you don't want to make the effort, that's fine too. But successful investors will make the effort to understand the companies that they're investing in. And so that's his main contribution. Value investing is pretty simple. He said, buy underneath some intrinsic value that he arbitrarily determined. It changed over the years. But I think his contribution later is, and it stands in contrast to what modern portfolio theory and efficient markets represents, but it's his lasting contribution is you got to do the work. You can't be a brain surgeon if you don't know anatomy. You can't be a plumber if you don't know how, systems work. And that simple but difficult exercises to all the credit of Benjamin Graham. John Burr Williams is discounted cash flows. You got to do the math. The present value of a security is determined by Irving Fisher, but who didn't do the math, but comes out and makes it very clear. 1906 is what the basis for any valuation of any business asset is, the future cash flows you can derive from it, the present value of any future cash flows. Irving Fisher says that in 1906. It's kind of self-evident.
These are early notions of value investing here?
Early notions of trying to put on a figure on an asset. Value investing is buy it cheaply, but actually putting any price on an asset.
Valuing an asset.
Valuing an asset is
But the
Irving
idea
Fisher.
of intrinsic value, the idea that an asset has a value that's independent of its price.
Yes, is separate
that
from
can
its
be
price.
determined objectively.
Hard to make it fully objective, but yes, with a patina of objectivity, an effort at objectivity. John Burr Williams does all the math associated with that, with discounted cash flows, dividend discount models, what the present value of a security would be.
Huge impact.
Huge impact, yes, absolutely. He's not the most colorful personality. He's not the most livid writer, and it was mostly quantitative. But he, again, establishes that which did not exist prior to that, and therefore it's worth his attention. And it does the math of the value is worth its future, the present value of its future cash flows. And then Keynes is fighting a bunch of other battles. But what he contributes to this is the subjectivity, interestingly, because he's at that point very much at odds with John Burr Williams, but the subjectivity of the exercise that in the stock market, what is at stake and what's driving the stock market is expectations and investors' feelings, the animal
and the
spirits
preponderance of uncertainty.
Uncertainty and how people respond to uncertainty. And there's a little bit of behavioral finance, irrational behavior finance in that people sometimes make strange decisions, but that expectations, we talk about the market as a discounting mechanism about what we think the future is going to be like. 2018 is a perfect example of that. Well, the notion that you're thinking about expectations would influence decisions that you make today, capital allocation decisions, is what he's writing about in the general theory. He has one chapter, chapter 12, and specifically about the stock market. He's trying to figure out expectations as it applies to employment and spending levels and consumption. But as part of that, the stock market has a role. And so the notion that what lasts from Keynes is, again, expectations. It's not just the net present value of the future cash flows. It's about the expectations of what the future cash flows will be like and what people will pay for them. So these three people didn't agree with one another. They were doing separate things.
Also contributing in different ways.
Benjamin Graham is teaching people how to think about companies. John Burr Williams is working out the math of present values. And Keynes is saying, it's not just about the neutral math. It's also, expectations and how they play in a crowd environment. There's a good deal of behavioral finance in that.
The feedback loops.
And he gives wonderful examples, which are quoted in the book. But those three concepts survived the post-war period or the war, and the academics, who we'll call it quieter times, the 1950s.
The memory of the uncertainty of the late 20s and 30s
Correct.
Was beginning to dissipate.
Yeah, and the quieter times, it's Harry Markowitz enters our story in 1952 as a graduate student at the University of Chicago. It's peacetime, it's relative prosperity, and he's trying to figure out these clever riddles. They're not crises the way they were for Keynes and to some extent Graham.
Up until Markowitz, if you asked someone on the street, or not, forget on the street, if you ask someone, I don't think you could even use the word financial professional before this time.
Right.
But if you ask the equivalent of what would have been at the time a financial professional, what is risk? How do you calculate risk? What would that person have said?
That's a great question, because the answer is it could be anything. There was no canonical definition of risk. One of my great issues currently in the marketplace, in the book, in my engagement with other investors, with companies, and with clients is the definition of risk. Modern portfolio theory gives you a singular definition of risk. It's not Ben Graham's definition of risk, by the way, and it's certainly not the definition of risk of most business people, and it's not even the definition of risk for many markets, developed markets around the world. But a mean variance optimization, that is an outcome outside the expected variance outside the expected return, is the definition of risk, total return. That's kind of technical and narrow. I object to it because it doesn't have to do with cash flows. It has to do with near-term share price movements, which is akin to me to gambling. But that was a definition of risk that in 1952 and elaborated in 1959 in a book-length version of his dissertation that Harry Markowitz worked out, that, variance from an expected return and total return over any measurement period, whether it's a short one or a long one. That's fine. That's a definition of risk, but it's not the only one. There have been other efforts at coming up with the definition of risk. I come up with my own in the book about cash flows, but the issue that I have with modern portfolio theory in the modern investment industry is that we're basically looking at share price movements almost on a daily basis and defining that as risk. And for those of you who are fans of Warren Buffett or fans of Ben Graham very explicitly states that share price movement is not risk. Go look it up. It's in the book. It's in my book. It's in Ben Graham's book. And I think we need to acknowledge that a definition of risk was not handed down from the mountain. It is not in some legislation. It's not in the genetic code. It's a choice by a 22-year-old at the University of Chicago. And you don't have to live by that definition of risk. You yourself, as an investor or as a business person, will have your own intuitive definitions of risk. And we are kind of stuck with this framework of risk that I just don't think makes sense 60 years later.
I'm going to quote you on that. It's a choice by a 22-year-old at the University of Chicago. Great quote. I actually had asked Howard Marks when he was on the program what his definition of risk was, and I believe he said the risk of permanent loss.
Which is one of the... Yeah.
The other thing I wanted to say, though, is, because mean variance is the way we think of it today's volatility, and value at risk models incorporate a lot of this and have generated a lot of risk as a result of that in terms of the investment decisions that are made based on assumptions about our ability to quantify risk, leading to situations where the entire portfolio can be underwater and the entire bank can go under. And banks use these models. But just to stick a little bit more on Markowitz and flesh this out, I want to ask you what the key concepts of MPT was, because Markowitz developed this efficient frontier, which a lot of people are familiar with, which balances risk with reward, right? And it is a roadmap for optimal portfolio construction. You mentioned his 1952 paper, Portfolio Selection. What are the key concepts of MPT?
Yeah, in its simplicity and compared to what went before, it's very, very good. And it is the simple notion that rather than kind of Carnegie's definition of risk, which is a few securities up and down, that you should define risk in terms of overall expected return and return in terms of overall expected risk. And that would be the kind of the standard deviation, which is a whole separate issue of price movement around. And as you say, creating a spectrum of risk and return. And the key way of doing, kind of the key insight of that is that diversification, again, not owning 1,500 securities through a bunch of index funds, but not doing what Carnegie was doing of owning a couple securities, but having a reasonable level of diversification was the way to get an optimal combination of standard deviation and return. That if you could only tolerate a low amount of risk and low standard deviation around an expected return, you would have to accept a lower return because those securities move around less, which is fine. And that if you wanted to achieve more, you would have to accept a higher risk, that is a higher standard deviation, a higher variance around the expected return because the securities move around a lot more. And the best way to achieve that would be through diversification. What it achieves is by, whether 15, 20, 25, or in his example, he's using 10 securities, including cash, is that rather than one or two, that you elevate diversification to a mechanism of achieving an optimal outcome. That was new. Full credit to Harry Markowitz.
What is the relationship between diversity and correlation? And how did Markowitz tackle that problem?
With a pencil and a spreadsheet, prior to Excel. The technical term is covariance. And what you have a bunch of securities, what you observe is they don't all move in the same direction at the same time. And if you add a few more, then the covariances decline over time. And so that's where you get onto the efficient frontier, is by having enough of diversification so that the covariance, or the lack of correlation, the covariance of the securities, you can mix and match the covariances to get an optimal outcome with an optimal level of risk. As long as securities don't move together, and generally speaking, not all securities move together at the same time. Last couple of months they have, but that notion that you have that securities vary in their returns with other securities at differing rates, covariance, that there was an optimal combination, an efficient frontier of securities that didn't move together with each other that would give you the desired return outcome because they didn't move together.
Because absence of correlation implied absence of volatility, or less volatility,
in the
way that he was thinking.
In the way that he was thinking. And the same thing, if you were seeking higher risk, you would still want to tolerate higher volatility returns, but you would still be able to dampen the volatility by having a diversified portfolio, because there the covariances would still serve, the lower covariances of a bunch of securities would still dampen the volatility of just having a few securities.
The idea being, also, this is at a time when markets were sort of just generally rising, and this is an idea where inherent in this is that you're trading idiosyncratic risk, the risk of an individual security, for systematic risk or systemic risk, the risk of the market as a whole. The idea is really fleshed out more fully later.
Yes, 10 years later.
By William Sharpe, was it?
By a number of people in the mid-'60s. And basically, when you have the capital asset pricing model, you're separating market risk from portfolio risk. And if you have a sufficiently diversified portfolio, you take out all the idiosyncratic risk.
Let's transfer there, because this is sort of where Markowitz was stuck, right?
Yeah.
It was the covariances and was building the optimal portfolio. How could you actually do it? Here's a theory, but how could you put it into practice?
It required knowing the covariance of every security versus every other security, which was a very difficult proposition. And at the end of his work, he says, listen, he doesn't say it's a great idea, but he said, this is actually really hard to do, and we'll let someone else figure it out. And that's where Bill Sharpe comes in.
To be clear, what you're saying there for those that are listening is, if there are 100 variables in the marketplace, the idea would be that every single variable would have to be compared to every other single variable individually in order to determine the covariances between variables, and that was extremely mathematically difficult because it's an exponentially difficult data set to solve.
Yeah, it's the securities themselves, that is their share price or total return movements vis-a-vis one another. The technology didn't really exist at the time, other than just incredibly labor-intensive to figure out the covariances of one security to another, and that was very hard. And if you have, even at that time, you had several hundred, if not thousand, practical investable securities, you can't really figure out the covariances of all of them versus another. You'd spend all your time doing that and no time owning businesses. So it was a great concept, that this efficient frontier elevating diversification to a mechanism of achieving a risk and return profile, but it was hard to do until about 10 years later, when some other characters enter the stage and dramatically simplify it.
Sharpe. So let's go to capital asset pricing model, CAPM, and William Sharpe and some of these other characters that you mentioned, and the role that they played in taking this theory MPT and solving, I think, primarily the covariance problem.
Yes, that's a fair assumption. There are other things going on, because efficient markets are also coming in, not the efficient frontier, but efficient markets. It's kind of a parallel dialogue. But really what they were doing, Bill Sharpe was doing, and several others, was coming up with a capital asset pricing model. It actually is not just an acronym. It's words that have meaning. How do you figure out what the price of an asset is? And in doing so, they dramatically simplify Markowitz's theory, because instead of needing huge covariance table and figuring out how every security moves vis-a-vis one another, Markowitz had suggested, and Bill Sharpe ran with it, that maybe there's a simpler way where instead of looking at every security versus every other security, you look at every security versus some underlying phenomenon, specifically an index, which you needed to
benchmark.
A benchmark, which was a great idea, except they didn't exist at the time. So in 1957, the S&P 500 comes into existence. There had been precursors to it, but from 1957 on, you actually have something that's kind of workable as a market benchmark. And by the 1960s, Bill Sharpe can say, okay, instead of having 500 securities and the covariance of all of them, I think it's 125,000 covariances you need for the numbers in the book, well, let's just figure out what the sensitivity of each security is to the broader market. It's systemic risk measure. And then you only need 500 numbers and an expected return for the market. And suddenly, it got a lot easier to create an efficient portfolio. That is a portfolio where you have a stated expectation of return, and based on historical volatility numbers, you have an expectation of what the volatility will be. You have to assume that those things are even true concepts. They're a little bit like Santa Claus, but at least the math was doable at that point. And also 10 years later, from the 50s to the 60s, computers had come along to help you figure out what the beta, which is an important...
That's what people think. That is the exposure to the market. That's beta.
Market sensitivity. So you need 500 of them. They were very hard to calculate as well. Computers come along in the 60s. Merrill Lynch in particular is willing to tell you the beta of securities, and they...
how closely they correlate to the broader market.
To the broader market. The sensitivity to market movements. You can suddenly create efficient frontiers on the assumption that the efficient frontier exists, but you can create said portfolios in theory due to the simplifications.
It's interesting to note here something that's obvious but could pass unnoticed is how increasingly abstract this gets, right? And this is what finance has become. It's become extremely abstract. Whereas we started in a period where people were exchanging on the curb stocks, right? Physically getting into fights, and in some cases fist fights. And here we get increasingly abstracted where we're dealing with models where now we're at a point where you're saying, in order to construct the optimal portfolio, I want this portfolio to correlate as closely as possible to beta, which is the actual market, which is basically like saying, I want my portfolio to be the market.
Well, if you want the market's return, then you're going to pick a portfolio that has a beta basically of 1. In theory, it might not work out that way, but...
If I want the safest possible return with an equity premium.
There you go. Yes, you would choose the market's return, which leads in a parallel development that comes out at almost the exact time, the efficient markets hypothesis, and the two dovetail together and get mixed all together because the most efficient application of the CAPM, capital asset pricing model, occurs in inefficient markets. But I want to go back to one of your points. Mm-hmm. We've shifted from a fist fight on the curb to theories of systems in equilibrium and capital asset pricing models. What has been lost? What has been lost is ownership of companies. What has been lost is the cash flows. What has been lost is decision-making under conditions of certainty. What has been lost is business stewardship. What has been lost is that you might actually own the asset and care about the asset. Once your investment decision is about beta or, in an earlier stage, just a covariance table, you don't care what the company does. You don't need to know. We had that experience in the late 1960s. And then during the internet bubble, no one cared what the company did as long as the stock was good.
Going up.
That we've had 50, 60, 70 years now of these abstract theories of investment. I am suggesting a less abstract theory of investment based on business ownership. This has been a great and interesting and intellectually stimulating 70-year ride, but we lost sight of the trees as we played around with the forest.
I want to get there, and I want to get to M&M, and I want to get to dividend irrelevance theory and the role of the dividend for Markowitz versus today and all that stuff. Before we do, though, I got a couple of questions. One is, when did this relationship emerge in people's mind between bonds and equities? Because that is a big part. If you go to an investment advisor, well, how old are you? Well, then you should be this much in bonds, and you should be this, because bonds are not correlated to equities. Where did this idea come from? Because, in fact, for most of their history, bonds have not correlated to stocks.
Yeah, the asset allocation models are also, which you're talking about the 60-40 bond, equity bond split, and depending on your age, you adjust that. It's a pretty modern phenomenon of the past 4 or 5 decades. It didn't really exist, at least I'm not aware of it existing prior to that. The reason is that until last 30, 40 years, the perception of bonds and equities was different than there was a spectrum of income. Bonds were guaranteed income, but the coupon was flat. Equities had dividends. They don't now. Many of them don't. The leading stocks in the U.S. market don't. But in the time that we're discussing, stocks had dividends, and you could judge the income stream of an equity, including the risk to the dividend, with the income stream of a bond, which was supposed to be guaranteed, though they could also fail. So you could have a spectrum of income, which is something basically I advocate in my final chapter, that we return or go forward with a cash flow-based portfolio theory that looks a lot like that. But when bonds, have an income income stream and equities don't, starting from the 1990s on, you're going to have this mix of assets to provide grandma with some income and then stocks for growth, and you get that asset allocation approach. That does occur. I don't cover a lot of the history of asset allocation, but you have to have an investment theory before you can have an asset allocation theory, and that really follows the development of MPT.
Are you saying that because most stocks yielded a dividend when these theories came into practice, that the relationship between bonds and equities was really one based on the fear or risk of default, that a bond wouldn't default, a U.S. government security was not going to default.
Or a corporate
bond. Well,
a stock could.
But a stock
could not pay its dividend.
Yeah, well, they could also
zero.
just decide not to issue a dividend.
Yeah.
That's interesting. Because now many people think of that relationship as dampening volatility, that if you want to dampen the volatility in your portfolio, you spread some risk between bonds and stocks. A lot of people think of that, those two as being anti-corollary.
The notion that there was a spectrum of income when Harry Mark in the 20s, 30s, 40s, 50s, there was a spectrum of income, and that the differences between bonds and equities was not as great. And there was a huge community of preferred stock in between, by the way, which emerged in the late 19th century to raise more capital for railroads. There was that spectrum. And one of the points that I would make in kind of about Harry Markowitz in that, when Harry Markowitz is coming up with a theory of mean variance optimization of returns, including total return, which is the share price change and the income component in any given measurement period. When Harry Markowitz is coming with, I think it's incredibly important for people to realize, all stocks other than the most speculative had robust dividends. Right now, the U.S. stock market has a 2% yield. At that time, the market had a 4, 5, 6% yield. And none of the stocks that he uses in his 1959 book didn't have robust dividends.
But what are your points, if I understand correctly, is that the equity risk premium was the risk that the dividend would go away.
Dividend would go away, or the risk and the expected additional return that from dividend growth. And the share price would follow the dividend growth. So if you're going to get a return above kind of the risk-free rate or, say, a bond rate, whatever the case may be, you had to take additional risk, which could be reflected either in the share price or the fact that the dividend might never materialize. Remember, an equity dividend is not a promise. A bond is. Both can be broken, but equity can be broken more easily than a bond.
So let's cover two more concepts before we move into getting deeper into the dividend, and that's the creation of alpha as a variable by Jensen. And then I also want to cover the random walk hypothesis and its relationship to Brownian motion and entropy. And you see I have this great picture here of Maxwell's demon, which is sort of, for me, the alpha generating investor in this model, if you were to sort of take the physics to the extreme. Let's talk about that because they touch on two different areas that I find really interesting. But let's start first with Jensen, just so we can wrap up the most essential variables of this model.
So a capital asset pricing model is a model that says, what would be the expected returns for an asset given its historical sensitivity to the market? And that can be a portfolio, not just an individual security or stock. And let's say, you have the sensitivity of the market of 100% and you have a risk-free rate of 2% and there's an equity risk premium, which is itself a whole nother book discussion of 5%. Then you would expect the return from that asset of 7%, 2 plus 5. Well, what happens if that asset returns 8 or 9 or -1 or -2? That is, 6 or 7 or 8 or 9, 10. It returns more or less than the expected rate of return.
You're fired.
Well, one of those you're fired, and the others you get a big bonus. And Jensen just said, listen, it doesn't appear that the capital asset pricing model isn't perfect. Most of the outcomes are not the exact predicted ones. Is there some talent here in getting a excess risk-adjusted, that's the key, risk-adjusted return? If it is, he had to give it a name in the formula because it's an excess amount, and it was alpha, Jensen's alpha. It's now be called alpha. And it now passes for a shorthand for competence in the stock market where you can achieve a excess risk-adjusted. How many times do I have to say that? Risk-adjusted return. Unfortunately,
on top of the equity risk premium.
On top of the equity risk premium. Unfortunately, too many people would just interpret it as just beating the market. That is not what, to be fair to the CAPM, capital asset pricing model, or Jensen's alpha implies. It has to be adjusted by the risk that you took. Again, reasonable people will disagree over the definition of risk. So Jensen's alpha becomes what the entire modern financial services industry is about currently, even if they don't define it that way or don't define it correctly anymore. It's how do you generate alpha? You can turn on CNBC and hear the word alpha 50 times a day.
Isn't there a conference, what's it called, Generating Alpha?
Alphaville or something like that.
Well, Alphaville is a great
blog.
FT Alphaville. There's also Seeking Alpha, which is great. But the CNBC has a conference called something Alpha. I don't know what it's called exactly.
And it's referenced in the book. I forget the name. But again, alpha is what it's all about. Alpha is a perfect example. And I would argue much like the very sensible ideas of Harry Markowitz originally, the notion of alpha originally, even the capital asset pricing model, which has gotten really dinged up over the last 40 years. But these were very sensible academic notions. What they've become in common parlance and in practitioners is something far, I won't call it sinister, but far removed from the claim that, hey, risk and return are correlated and that there's an ideal combination or that you can try for risk-adjusted excess returns a la alpha. Those are okay concepts. I may or may not agree with the underlying propositions, but there's nothing wrong in theory with the concept. But what they've become in the marketplace, how people define it. One of the big issues with modern portfolio theory, mean variance optimization, is when the assets reprice on a daily basis, you get people chasing their tails and measuring using MPT statistics on a daily basis. Kind of similar thing with alpha, that people are using it not in terms of risk-adjusted excess return, but just excess return. Mm-hmm. That is not adjusting for risk. So great ideas, academic ideas, 1950s and 60s, reflecting the enthusiasm for social science and quantitative solutions to social problems, explaining the human animal, borrowing from the natural sciences of the 19th century, that there are rules and the way systems work in the natural world is the way that humans work as well, and that's how we're going to apply it. And you get all these wonderful theories in the 50s and 60s. What they've become in the marketplace 50 or 60 years later is, I think, far less useful, and that's what I'm trying to challenge.
We did a great episode that I highly suggest to listeners. It doesn't fall into the category of economics. It's episode 19 with founder of the High Energy Physics Group at Los Alamos, Jeffrey West, on scale in biological versus socioeconomic systems. Super relevant to what we're talking about now. I'm not going to go into further detail about that. I want to mention one thing before we move forward, which is that we didn't really describe this, but it's worth mentioning, which is that modern portfolio theory is built on top of an assumption about a normal distribution of outcomes. And one of the things that anyone who has been, unless they've been living under a rock for the last 10 years, knows that markets have a tendency to deviate far beyond what is the statistical variance of a normal distribution, what are known as fat tails or kurtosis. So we're going to get into that later because I want to just tie off this one part about the random walk hypothesis, and then I'm going to make the second half of our interview available to our subscribers. But let's touch on this now, this point about how did these theories that compared markets to the motion of particles in a vacuum, the random motion, Brownian motion, explain this to me. Where did this come from?
Yeah, so this is, again, similar but parallel track. A lot of the assumption that you can't beat the markets is part of modern portfolio theory. They both come of age in the 1960s. There's a kind of a coming out party in terms of the efficient market hypothesis, but it was a parallel and separate development. And there are lots of academic and quasi-practitioner works for the past century trying to figure out whether there are patterns in the numbers. If there are patterns in the numbers, then you can trade those patterns. If the numbers are random, then you really can't. If the outcomes are random, is this data set random, or are there flags and tops and double tops and bottoms and trends that you can track? The Dow theory is a trend theory. There are some fascinating stories. They're separate from Harry Markowitz and Bill Sharp. There's a great story of a French mathematician in the bourse in the late 19th century, Louis Bachelier, who basically comes up with the efficient market hypothesis 60, 70 years before Eugene Fama and the others bring it to the attention of others, of Wall Street. And there are a couple lines of thought there. One is mechanical and technical in its physics about Brownian motion, which is particles of pollen in water observed by an English botanist, Robert Brown. The other is just looking at data sets of commodity prices and share prices and government bond prices and subjecting them to the analysis that the 20th century calculations permitted and saying, actually, there's no pattern here. And whether you get to an efficient market hypothesis through this physical notion of Brownian motion or random walk, or whether you get to it through just kind of hard labor of looking at all these prices on the cotton prices or share prices or bond prices on the stock exchange or commodity exchange, kind of end up at the same place, which is that the idea, if you put enough participants to work in a market and everyone is paying attention, that's really key. Because if everyone believes in efficient markets, I can guarantee you one thing. Markets are not efficient at that point. But if everyone believes they can make a buck, according to the efficient markets hypothesis, if everyone thinks they can make a buck by outwitting their neighbor and they are active in the markets, you actually get, in this theory, an efficient market. And that history comes out and makes its way to the marketplace in the 1960s and 70s, notably by Eugene Fama, but it had a 60, 70-year history prior to that. And modern portfolio theory and efficient markets kind of come to the fore at the same time, and the capital asset pricing model, very interestingly, joins the two, not so much explicitly, but simply the CAPM works best in an efficient market, at which point the best approach to take is to own the market, which was not feasible at the time. There was no Vanguard product at that time. That becomes later, or about a decade later, and that you would toggle risk with the amount of cash that you would have or money that you would borrow and so forth. So these are two parallel structures. And again, what's lost in the efficient market hypothesis? Business ownership, decision making. It's just a mass of numbers. Doesn't care what the economic conditions are of the company or of the commodity. It's just a blender full with numbers, and you might as well not try to make any decisions about it. The getting back to business makes the argument very simple, not trying to outwit everyone in the market, but that you can own a business, you can make business-like decisions based on cash flows, despite being intimidated or confronted by academics saying, no, you can't, there's no point to it.
Well, we discussed Michael Jensen, before we were talking about alpha. When he looked back, he found alpha. I assume that certain people believed that alpha was possible to generate consciously, but there seemed to have also been a school of thought that developed that sort of saw it as a random outcome. Is there a distinction to draw there?
Well, the big problem with alpha in the early studies is that the way to measure it involved looking at active managers in mutual funds in the post-war period. 45 to 64 was one of the data sets. Bill Sharp did the same thing. Jensen looked at these mutual funds. They only had 10, 15, 20 years of data, and it was right after the World War II. And the mutual funds had very high fees. And they very appropriately looked at the returns after the fees. You didn't have the type of measurements that you now have with a much bigger data set. And basically said, in theory, this is kind of Paul Samuelson, the MIT economist, saying, listen, it's possible to beat the market. It's very hard. And after fees, it's even harder. And the investment management fees in the 1950s and 60s were a lot higher than they are now. If you had alpha, your fee would have taken it away. And so the net result for most investors is saying it's there, but it's hard to achieve. Fees have come way down. Of course, the market, you could argue, is more efficient than it was in the 50s and 60s, but fees have come way down. So now, going forward for the next couple decades, the question is, okay, in a low-fee environment, we'll see whether alpha generation is possible. I certainly think to the extent that you can make good business-like decisions in the marketplace based on cash flows, which is, again, not the definition of alpha, but it's my definition of sensible investing, that it is certainly possible. And I think, active managers certainly believe that they have, and certainly in this kind of lower fee environment, have the ability to do so over the next couple decades.
So Daniel, I want to get into your definition of intelligent investing, how you invest. I want to get into Miller and Modigliani. I want to get into the evolution of MPT and its implications for today. And I'd be curious to hear your macro view on the economy. I want you to stick around. This audience is going to be available through our Patreon subscription that you can do through our website. And you can go to hiddenforces.io. And we also are making transcripts and rundowns available for this interview as well, which are full of notes and information and links to all the stuff that Daniel and I are describing. Thank you for coming on the show.
My pleasure, Dimitri.
And that was my episode with Daniel Paris. I want to thank Daniel for being on my program. Today's episode of Hidden Forces was recorded at Edge Studio in New York City. For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to overtime segments, episode transcripts, and show rundowns full of links and detailed information related to each and every episode, check out our premium subscription available through the Hidden Forces website or through our Patreon page. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.